Apollo Hospitals, top Nifty gainer today on the news that the company will create a newly listed entity by consolidating its pharmacy, digital health and pharma distribution business into one platform, with the hospitals being the other platform.
NMDC price cut due to weak global prices and onset of monsoon comes into effect from today. The price cut is larger than expected, which is causing the stock to remain lower by close to 3%.
Shares of Gabriel India surged 20% after the company has announced a scheme of arrangement for the amalgamation of Ancemco India into its Asia investments, the subsequent demerger of automotive undertakings of the company.
IDFC First Bank gains after Investec upgrades the stock to buy rating with a target price of 90 rupees per share. The brokerage says that bank's earnings per share growth trajectory is compelling.
Dixon Tech, on the other hand, trades 3% lower. Morgan Stanley has downgraded the stock to underweight with a revised target indicating a 23% downside. They expect earnings growth to slow down between FY20 and FY30.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel D'Souza. With me is Mangalam Malu. And the market's well in a bit of a range. Mild positive bias is what we're seeing, but we've got a couple of managements on the show. So let's get straight to it.
Let's get straight to it. The first management on our show is Northern Arc Capital. We have Ashish Mehrotra, who's the MD and CEO of the company, joining in to discuss the business outlook, more importantly, the FY26 outlook as well. Ashish, thank you so much for joining in. A two-part question. One on the demand side and the second on the supply side. On the demand side, the street is believing that credit growth remains a little weak in terms of offtake, etc. How have you seen that, and what's your prognosis for this year? What sectors would lead it, and what sectors would you not lend to this year because of asset quality issues? And second is the supply side. I mean, with the rate cuts coming from the RBI, one believes that the cost of deposits or the cost of funds will reduce. Would that be margin positive?
Hey, hi, good morning. Delighted to be here. I think you kind of rightly picked it up. The demand tends to be slightly muted. We're seeing some of the sector where is some amount of correction being made, especially in the MFI side. We saw that the guardrails being implemented. We're seeing some early signs of improvement. To my mind, it will take a quarter or more for it to stabilize. I think MSME is grossly underserved. It contributes significantly, if you look at it, in parts of our GDP, almost 29%, 40% of exports, 270 plus million employment. But 70% of them have very limited access to formal credit. And I think that's where we believe there is a big demand coming in. Consumer tends to be, which is predominantly consumption-led, should have a steady state demand. We saw some bit of rationalization of that demand over the last few quarters or over the last year or so. But I think it will remain robust as we look forward. Our sense is, the rate cuts, the benefit will start trickling in as the MCLR get reset. You can see an improvement of 30 to 40 basis point by the end of the year, reflecting in the better quality NIMs for institutions like us.
All right. Hi, Ashish. Good morning. Good to see you, Ben. So in terms of a growth, if you could help us out, what are you looking at? And if you could give us a band on the margins as well. As you're saying, I think you have more than 60% of your borrowings from banks, right? How much of it is on floating? How much of it is fixed? And in turn, what does it mean on the NIMs?
I think we probably have, if you compare us to our peers, have probably one of the best liability franchise. So we have 30% coming from the global multilaterals, which is largely the offshore borrowing, which tends to come at a marginally better price and for a longer tenor. About 70% comes from the domestic institutions, and large part of that is floating. That is predominantly floating. Okay. So we should see that benefit coming in. We see the rate cuts and the implication of that as a consequence of that reflecting in MCLR tends to follow a little bit of a delayed approach. That's why I'm saying 30 to 40 paisa by end of this year and another 30 paisa plus next year. I think that's where we should see the flowing in as far as cost of funds are concerned.
All right, so 30 to 40 basis points improvement in NIMs by the end of this year and another 30, 40 basis points by the end of next year as well. Ashish, we didn't get the growth question.
Come to that.
What?
So I
Yes,
think
please go ahead.
we should look at between Q2 and for the rest of the year growth coming back. We've seen calibration in MFI, we've seen calibration in the consumer and some of these other sectors. There is a big demand which needs to be addressed. Like I spoke about MSME, there is a massive demand. We have full suite of products between secured, working capital. We have our own funds which we call emerging business funds, where we deploy. I think we are pretty confident of anywhere between 22 to 25% growth as we look forward for this year.
And on a follow-up to that itself, and
allow me to finish one more part.
Yes, please.
Please go ahead.
Yeah, and plus you should see improvement in NIMs, because for us also the expansion of the retail book, that should add further to the improvement of NIM. So this NIM improvement is not only coming on account of cost of funds, but also come on account of the book and the build out of the book in that retail segment.
So just to confirm that, over the last 3 years, your NIMs have increased from 5.5% closer to 8.3%. Now you believe that another 30, 40 basis points improvement comes in on the back of cost of funds. Yeah. And how much more comes in on account of your mix change? And
we should see another 30, 40 improvement. So we should see 50%, 50 to 60 basis point improvement in the NIM.
So closer to between 9 to 10% is where your NIM should sustain?
Actually, if you look at a NIM on an aggregate basis, a NIM is about 9%. And you add the fee income, we have a probably very unique fee franchise coming on account of a funds business and a very powerful placements or a credit solution business where we provide credits to the both domestic and global multilateral product, which is a placement business of ours and a bonds platform. We make about 80 basis point of fee. And as we continue to build the fee franchise, I think that you should see over the next couple of years improvement on that. So your loaded NIM, which is currently at about 10% on a last year, if you look at it, we should see improvement as we go forward on it on a year-on-year basis.
Okay, all right. What about asset quality, sir? Before we let you go, we must talk about that. Are things easing out? There was a fear a few months or so ago. That seems to be receding a little bit. Would you agree? Or do you think we still require a couple of quarters before we're out of the woods?
I think we are seeing signs of improvement on X-bucket delinquencies, including in the microfinance book. While we don't have a very large exposure on it, we have a very small exposure on balance sheet, but that's a good indicator to how do we see demand and the performance on the credit demand from bottoms up chart if you start looking at on a product continuum basis. While the credit cost in Q1 may remain marginally elevated, my sense is H2, you will start seeing improvement in the credit cost.
So if you could quantify that, because last year your credit cost was 3.2% annualized.
Yeah.
Where does that number settle at by the end of this year?
So last year credit cost has an element of an accounting adjustment, which we had to do on account of taking for the DLG and obviously an overlay. Our sense is if you remove both of them, we were at 260 basis point. On a forward-looking basis, if I say, I think we should hover between 250 to 280 basis point around that piece.
All right, take that point. Thank you so much for joining in, Ashish, and giving us your view on growth going forward, your margins and credit costs as well. You do believe that MSME will lead credit growth going forward, and you are looking to increase your exposure via that front itself. Take a short break. In fact, as we do that, let's get you some ideas for profit coming in from our colleagues at Money Control Pro. And today we have Anant Chaudhary joining in with a stock that he's been tracking.
The stock we are discussing today is SP Apparels Limited, a leading exporter of kids wear garments. The company supplies to major global retailers like Tesco, Kmart, Mothercare, with a primary focus on the UK market. In the retail space, SPL markets the Crocodile menswear and sportswear brand, as well as Angel and Rocket, a premium UK kidswear brand. We are bullish on the company due to its strong positioning in the niche kidswear segment, which has high entry barriers. While the company faces some tariff challenges in the US with a 10% import duty, however, its exposure to there is limited to 20% of their exports. Importantly, SP Apparel is a major beneficiary of the recently signed India-UK FTA, with a contribution of 35 to 40% of their exports. The acquisition of Young Brands Apparels Limited enhances product diversification and enables cross-selling synergies, expanding into men's and women's wear for brands like Jockey and Marks and Spencer across the US, UK, Japan, and Canada. The company is also expanding capacity, including a new facility in Sri Lanka, set to come online in FY26. Management has guided for 2,000 crore revenue by FY27, while the stock trading at an attractive valuation of 13 times on FY27 earnings. But key risk includes freight cost volatility and a potential global demand slowdown.
All right, Anand, thank you so much for that. We'll take a short break, not before the news that Reliance has moved to the high point of trade. So the stock has been doing extremely well. From the lows, it's seen a smart recovery and currently has moved to the high point of trade, and that's contributing the most to the Nifty, even as the Nifty Bank is down 85 points. The intraday chart of Reliance comes up for you before we take that short break, and then we go across and, get the management of Ellen Barry after their listing. So you stay tuned. Reliance has moved higher. But on the other side, we have the management of Ellen Barry, the new listing.
Welcome back. It's been a terrific debut for a couple of stocks today, and one such name is Ellen Barry, the industrials gases. The stock, in fact, listed at a 20% premium to its issue price. And now we have the management who will be obviously looking quite happy. We have the CMD, Mr. Padam Kumar Agarwal, as well as the joint MD, Varun Agarwal, who join us. Gentlemen, congratulations. Good to see smiling faces and welcome to the stock market. Well, we're going to be interacting almost on a quarterly basis, if you'd like, even more than that. Let's get a couple of numbers out of the way, though. Since now you're already listed, you'll have the leeway to go ahead, and the regulator as well will be happy if you'll give some kind of guidance. Now, in the last few years, revenue growth has been in the vicinity of 20-25% approximately, but profitability has been even better. So let's get those numbers out of the way. Can you continue at this sort of a revenue growth rate? And also margins, beautiful move, right? From high teens to around 35%. Can you hold out here?
Yeah, I'll take that, actually. Thank you for having us on the show. And look, the growth rate is going to continue. We are putting up a lot of new capacity, which will be coming online over the course of the next year or so. Margins, I think, as we grow, we get operational leverage, and we would expect margins to, in fact, edge even higher and, sort of hit an EBITDA margin number, which could be even upwards of 40%.
All right. So you believe EBITDA margins can be upwards of 40% as well. By which year would that be? In FY26 itself, that's a possibility?
Once a new capacity comes in, so FY27 would be a better indicator.
All right. Just a follow-up on that, the new capacity for which you are deploying about 105 crores in terms of capex. That was one of the objects of your issue. What is the kind of turnover or annual revenue that that accrues for your business? That's one. And secondly, you will be paying about 200 crore of debt as well. What does that take your balance sheet to? Do you become net debt free?
Yeah, we do become net debt free. And in terms of turnover, just to guide, we were doing about 300 plus crores of turnover based on a capacity of about 600 tons per day. We expect our capacity to go up to north of 2,000 tons per day. So, if you extrapolate those numbers, we would see strong revenue growth going forward.
So back of an envelope calculation will suggest that your capacity, currently you're at 600, right? And you're going to go to 2,000. So effectively, your total turnover potential is more than 1,000 crores.
Yes, I think so. We were at 600. Currently, we are running at 1,370 tons per day and looking to expand this to about 2,200 tons a day.
So revenue potential?
The revenue potential from here is significantly higher.
So 1,000 plus crores, right?
Yeah.
And by when do you hit that?
I mean, that's a sort of more of a medium-term plan over the next 3 to 4 years is what we are targeting.
All right, let's go across to Mr. Padam Kumar as well. Because you are setting up so many capacities, because you are hopeful of this 20-25% sort of growth continuing with margins at around 40% odd, what would be the end-use industry that would drive this growth? If you could give us a sense of what proportion of your revenues comes in from what industries. What we're given to understand is that you have exposure to steel, pharma, chemicals, and hospitals. They are all major drivers of your demand. If you could give the breakup of what industry do you contribute to the most?
As of now, we are getting our maximum revenue from iron and steel businesses. Pharma comes second. Going forward, we feel that these businesses will remain our mainstay. At the same time, we would expect additional revenues from healthcare, and there is a host of new age industries like solar and electronics, semiconductor, etc. We are positioning ourselves to cater to the upcoming demands of this fast growing sector.
Right, and if you could give us a breakup, you said maximum revenue comes in from iron and steel, how much of that it would be, and is there any margin differential in the industries that you supply to? Say healthcare gives you more margins or everyone gives you similar margins, because at the end of the day it's just gas that you're supplying.
Generally, we would expect something like a 30% from iron and steel and slightly lesser from pharma and bulk drugs. Prices are generally the same for all industrial products, but when we are talking of products other than industrial, even including medical, because of requirement of quality consciousness and a few tests also which we do, those would generally tend to give us slightly higher revenues.
All right, just a quick question about competition. Do you compete with the likes of the Inox Group, Linde? Could you comment on that?
Yes, I mean all manufacturers of similar products remain our competitors. Linde definitely had a head start, being more than a 100-year-old company. So, I mean, it's we do compete with bigger companies bigger than us, and we will continue to do so.
Okay, no, what we understand is, and I'd like Varun to answer this, because is there any exclusivity clause that you have as against competition? Because, the feeder industry is the same. You have the end user industry, which is the same. What differentiates your business from the others? What is your moat, so to say? Is there any exclusive contract that you have with any sort of upcoming capacities?
No, so generally, the customers that we cater to, we are their exclusive suppliers in general, and we typically sign very long-term contracts in the region of 5 to 15 years. So, the moat at the customer level is very strong. At the industry level, of course, we all compete because we provide similar products and services. But there are distinguishing features, in terms of our competitive advantage. We are very agile. We have a strong customer connect. So those are our core strengths. And of course, our competitors are strong as well. At the customer level, as I said, there is a great deal of exclusivity because of the long tenor of the contract.
Got it. All right, gentlemen, appreciate you joining in, fielding our questions. Peak revenue, as per what the plan goes about, is more than 1,000 crores. And if you're going to do margins of around 40%, the EBITDA number translates to around 400 crores on a current market cap of around 7,700 crores. Thanks a lot for joining in. Enjoy the day and congratulations on this listing. We look forward to having a chat with you all rather soon. Well, for the time being, we slip into a break. Come back, continue our focus on markets. Don't go anywhere.
Welcome back. Marginally in the green for the Nifty as well as the Sensex. What is dragging it lower is the Nifty Bank, which is atop my head right now, up actually down almost 0.25%. No real worries. It's the mid-cap index that we're watching out for because that's underperforming as against yesterday. But the indices atop Nigel's head, both of them held up fairly well because of Reliance Industries, which is supporting on the way up. So Nigel, that's a decent piece for you to carry. Two apiece. I'll try and support this one. Well, you support that one as we wrap up on this edition of Chartbusters. Thank you so much for watching. The team of Trading Hour after this short break.